Did you know that the average rental rate for a one-bedroom unit in some Canadian cities has increased by over 17% in just a year? Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. Inflation and affordability are front and center for Canadians, and affordable housing is one of the most pressing concerns for individuals and communities worldwide. According to an opinion piece by Scott Fash, Executive Director of BILD Alberta Association, we need more supply, particularly in purpose-built rental availability, to truly tackle the affordable housing crisis. This challenge requires exploring alternative avenues that foster innovation, encourage investment, increase supply, and provide financial support to our most vulnerable. The housing markets across Canada, from Alberta to Ontario, can vary greatly. For instance, the Calgary market is facing the highest degree of immediate stress in Alberta, which can quickly spread to other cities like Edmonton and Lethbridge. Although the scale and immediacy of these challenges may differ, the actions and solutions needed to address them remain the same. Rent control has become a hot topic in Alberta due to significant recent increases in rates in municipalities like Calgary. It might appear to be a simple solution to a seemingly straightforward problem. Over the past year, the average one-bedroom unit has increased by 17.2%, and a two-bedroom has increased by 16.9%. This follows an extended period of relatively flat rental rates. Data from Canada Mortgage and Housing Corporation shows that from 2013 to 2019, the average rental rate for a one-bedroom unit increased by only 0.6% a year, and for a two-bedroom by 1.0% per year. In most jurisdictions, rent control would allow for a 2% per year increase. However, significant and rapid population growth means new rental supply cannot keep up, despite the industry building record numbers of new housing units and specifically purpose-built rentals across Alberta's largest cities. Rent control policies can ultimately prove to be ineffective in addressing the root causes of unaffordability. They often lead to underinvestment in the maintenance of existing buildings while acting as a barrier to investment in new projects. Instead, government tools to make projects feasible have been a key factor leading to the increased construction of purpose-built rental units. A new tool by Canada Mortgage and Housing Corporation called MLI Select allows builders and developers to access higher loan-to-value ratios, increased amortizations, lower debt coverage ratios, and reduced premiums, provided they meet affordability and energy efficiency requirements. This has resulted in an explosion in interest and construction from companies who otherwise might not have entered the world of rental housing. Unfortunately, many of these units are not yet finished, and the true benefits of this policy have not been seen to date. Approvals and construction timelines take time. When we balance supply with demand, we see healthy and affordable rental rates, as was seen from 2013 through 2019. Better alternatives to rent control exist. Recommendations include reforming Canada Mortgage and Housing Corporation fees and the federal tax system, and providing low-cost, long-term, fixed-rate financing for constructing purpose-built rental housing. Rent control is often pointed to as the easy solution, but it ignores the greater forces that impact rental rates and the need for more supply. Better solutions exist, and the tools are readily available. So, let us get going. Shifting gears to some commercial real estate insights, Altus Group has released a wealth of new information and perspectives that could be highly relevant to multifamily investors and developers, especially those in Ontario. Their recent Canadian commercial real estate valuation analysis for the first quarter of 2025 sheds light on the current trends across retail, industrial, multifamily, and office sectors. Multifamily real estate continues to be a strong performer, with valuations reflecting steady demand. This sector is benefiting from ongoing urbanization and demographic shifts, particularly in cities like Hamilton and Kitchener-Waterloo, where population growth is driving rental demand. Industrial real estate is also experiencing a significant boom. The rise of e-commerce and the need for logistics hubs have driven up demand in this sector, particularly in areas like Burlington and Oakville. This presents ample opportunities for investors looking to diversify their portfolios. On the office front, there is a mixed outlook. While some areas are seeing a resurgence as companies return to physical workspaces, others are still grappling with high vacancy rates. However, this could be an opportune time for savvy investors to acquire undervalued properties in anticipation of a market rebound. Retail real estate, according to Altus Group, is entering a potential golden age, driven by generational shifts and technological advancements. Gen Z's renewed interest in in-person shopping and the integration of artificial intelligence into retail operations are reshaping this landscape into something quite promising. The insights from Altus Group highlight the dynamic nature of commercial real estate and the importance of staying informed. As we navigate these trends, remember that every challenge presents an opportunity for growth and innovation. It's an exciting time to be involved in real estate, particularly in the multifamily sector, where the potential for wealth generation is substantial. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.